Hi, I'm Michael Columbus from Family Wealth and Legacy. Thanks for joining me for another quarterly market update. We're going to be looking at the fourth quarter of 2021 in review and giving you a little bit of our outlook for what we're seeing coming forward. So as we came out of 2021, you can see the leading economic indicators. Everything's still positive. Everything's looking good. We hit a peak in April of 2021, but when we came out of it, everything's still looking good. Then everything's positive. Consumer expectations was negative, was down, and new orders were flat. Other than that, the leading economic indicators are all pointing to a very healthy economic situation. That does not mean that we don't have volatility in the stock market, as always, but the economy is looking good. Even when we have downturns in the market, we just always want to remember and remind people that we don't move in and out of the market. We don't try to time the market. Even if looking at February to March of 2020, the market was down about 34% in just over 30 days. But then March of 2020 to December, 21, we're up 113%. I don't think most of us expected a snapback at that level. So we're pretty excited about where we're at right now. And we'll show you some other reasons why. We also want to keep in mind, that 32 out of the last 42 years, the S&P 500 has closed, ended the year in a positive note. Now, you'll see an awful lot of red in here. Every year, there is volatility in the stock market. Every single year, there's volatility. There are times when the stock market is ending, has a negative point in the year. Sometimes we're down 34%, but we still ended up 2%. Down 19%, ended up 27%. And here's another one. We were down 19%. Flat for the year. I'll take that sometimes, but I just want to keep reminding everybody that, 32 out of 42 years, the market's been positive. That's a 76% chance that the market's going to end positive, but there is always going to be volatility inside of every single year. We closed out 2021 at just under 4,800 on the S&P 500. And yes, the first part of January here has been bumpy, but we haven't had lots of bumpiness. We ended the year a little bumpy. We got a little bit of a tiny Santa Claus rally in 2021. And now it's, we've got some volatility happening right now based on the strength of the economy, based on the leading economic indicators. We'd say it's a great time to utilize that, excess cash that you have on the sidelines, if you have any, to start getting that moved forward. And why? Because GDP, gross domestic product, 70% is powered by consumer spending, by personal consumption. And we've talked about this ad nauseum. And we just want to remind you again that the stock market is driven by what you and I are out there buying. The companies that, we support, the companies that we spend our time with, we search on Twitter and Facebook and Google, and we see those ads, and so we're consuming all the times. We're going to the grocery stores, we're getting gas, we're heating our homes. That's consumer spending. That's what's driving the market. And the other thing that I want to point out is, if we go back here to the 80s, we had household debt service ratio at about 10.6%. That rose up into 2007 to 13.2% of disposable personal income as a percentage of the debt as a percentage of the disposable personal income was very high in 2007. You remember what happened? Well, look at where we are right now. Fourth quarter of 2021, we're about 9%. It's about the lowest we've been in 40 years. So we're doing really good. There's a lot less debt in the marketplace right now. And then we always talk about cash on the sidelines, what's in the money markets. Remember what happened here? We had a great big giant run up and how much cash moved to the sidelines during March of 2021, and going forward. It started to get reduced. It started to get pushed back in the market, but consumer expectations, people think and feel that there's something bad, coming around the corner, so that cash is still there. Remember, cash is earning about what? Well under 0.5% right now. It can't stay there. So this is just, in our opinion, this is good fuel for the fire to keep the markets going. Here's another one. We're talking about why the cash, doesn't work. Right now on a, $100,000, you're averaging about $70 a year. Well, just to stay current and beat inflation, you need about $5,000, about $4,960 to be exact, just keep up with inflation. So, when interest rates are under 5%, you're not keeping up with inflation, you're actually losing. So, people out there, they will be moving the money to the money that's in cash to the stock market, and we'll be looking, watching that. Inflation's the big, buzzword right now. And we know interest rates are low and they are worse due to inflation. However, this still doesn't compare to what the 70s or 80s looked like. Could it? Possibly. But the only thing that you can do right now is track it and watch it. And we're going to be doing that for you so that you're not having to worry about it. And then if we look at the levels of inflation, what bodes well? Well, you can see during high levels of inflation, industrials and real estate and materials do perform the best. And if you remember, as we've adjusted portfolios, we've moved more to industrials and materials, and we've never abandoned the real estate markets. We've just always, kept our sliver inside of there. So we're a portfolio utilizing asset allocation. We're set to do exactly what, utilize asset allocation. It's just different assets will be performing during an inflationary period. And here's a quick note, just looking at it, this is one of the first years, in a long time where cash actually beat the bond market. It doesn't happen too often. And think about what cash is giving back. So it had a negative year in the bond market, but this is also why we utilize heavy asset allocation. If you're in retirement and we have bonds in your portfolio, the reason why we have them in there is because, bonds will perform very well, but even during the bad years, it's not so horrible. -2, -1.5, can it do worse than that? Absolutely. But, this is pretty normal. The bonds may not perform really well like the investment portfolios. They may not even keep up with inflation at all times, but they add some security and some, take out the bumps of the stock market by utilizing the bond market. Again, asset allocation. As always, we're going to go back to our 3-bucket approach and, figuring out you need 1 to 3 years of cash between Social Security, pensions, and guaranteed income. And then what you've got in your savings, checking and savings account. We need 4 to 7 years in your bond portfolio, and everything else then can be in equities. So once you have those buckets figured out, then, put the rest into equities and you're off and running, not trying to time the market. We're just going for time in the market. We're here to help you. We want to help you. And we look forward to continually helping you as you're going through this crazy period of time that we've been experiencing. So thanks for joining me today. I appreciate it. If you have any questions, you can get a hold of us. You can call us, you can email me, you can find us on Facebook or LinkedIn, and we're happy to answer any questions that you might have. Have a great day. We'll talk to you soon.